Welcome to the Dividend Talk podcast, episode 32, How to Recognize a Declining Business. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Yo. Welcome back to another episode, guys. I'm here with European DGI. Hogate mate. Did I say that right? Hogate mate. I've been trying to learn Dutch this morning. I'm guessing that's not right.
I have no clue what you're trying to say.
I'll stick to English for now.
Okay.
I was trying to.
How
are you, buddy? I was trying to say.
Hoe gaat het? And then maat.
How are you, buddy?
Well, I'm really excited. Come on, fiscal year 2020 earnings seasons has started, First big companies announcing their earnings and a shitload of earnings coming up in the next 2 weeks from European companies. So, I had no time almost to look at it this week. Too much work. So I really need to free up my calendar in the evenings for next week because, it will be lots of fireworks, lots of dividend announcements. So, yeah.
Did you get a chance to look at Procter & Gamble anytime? I know you wrote a post on them recently.
I saw that they had all over around 8% growth, and I think it was also Dividend Wave who had a really nice tweet about it. So they knocked it out the park. But I'm not surprised, actually. I expect this from most of these kinds of consumer staples because in COVID-19 we've been just spending more stuff, which is in their line of business. So
yeah, I've kind of stuck to a Dutch team this week. Aside from trying to learn awfully how to say how are you, I was looking at the news, and you're quite a crafty bunch, aren't you? There's restrictions after coming in, I believe. There's some sort of curfew over there. My brother's living over there, and he was telling me this was coming in. But lots of Dutch are going out buying delivery uniforms and borrowing dogs because apparently walking a dog is essential, so you can do that. Or if you're delivering takeaways, you can go and go outside your curfew. So you're pretty crafty over there.
Yeah, why? Okay, well, I remember one time a story, and I don't know totally if it's true, but there has been some tests in the past, like with taxing or something like that, or that you had to pay when you go on the highway with let's say, a loan. And I don't know exactly what it was, but there are these stories that someone used such a sex doll as a second passenger, so that it doesn't look like you're driving alone. Yeah, and dress them up a little bit, and that's from before my time, when I was still probably too young to understand this kinds of stuff. But if there's a listener from the Netherlands that can confirm these kinds of stories, then I would love to hear more about it.
The effort of putting a doll or something into your car and dressing it up it's amazing.
Well, I think it's not even that. Like just buying one.
Kind of awkward walking into a shop. Can I get a doll, please, for my child?
If I'm talking about sex dolls, come on.
So we move on before this gets out of hand.
Well, so my news of the week was Biden, right?
Of course.
He became president, so let's see if the world is a little bit better off now.
Who knows? All I'm reading is the US presidential stuff COVID and Brexit. I'm just sick of it all. I just want it all to go away, and at least we have earnings, as you said, earnings week, earnings month is coming up literally, and it'll keep me occupied and away from all these news sites.
Yeah. So let's get started then. I'm really curious.
Yeah, this week we're going to talk about how you recognize a decline in business. But before that, there was two companies of interest, and one of them was Intel earnings. I know we spoke a little bit about them last week. They've announced that the new guy Pat has taken over in the 15th of February. They gave us a nice little raise. There was a 5% dividend increase there, which was a positive. The revenue was up year on year, and the free cash flow was up. But it wasn't all a bed of roses. The fourth quarter was declining, so this is the second quarter in a row. They've already said next quarter is going to be even worse, so they know that this is going to hit us. The PC business did quite well, but the data side of it is just not happening, I suppose, the way Bob Swan would have liked. So they dropped 8%, 9% in shares, partially because I think they've gone back a little bit on outsourcing their chips. There was talks that they were going to do that, and I know Pat has said that they're going to do that, but maybe not at the scale that everyone expects. And part of this may be because there's legislation coming into the US to fund chip makers. I think the US are kind of scared that all these big chip makers and manufacturers will be based in China. So they're trying to bring stuff home. I know they have to outsource a lot of it at the moment over to Chinese companies. So it'll be interesting to see how much funding they get. I know the law has been, I don't know if it's been passed. And I know that the level of funding and the recipients haven't been confirmed yet, but it'll be interesting to see if, I believe it will be there, but how much Intel will get, and will that drive their decision on outsourcing chips. So look, it was a mixed bag. From my point of view, I'm happy with the dividend increase. The free cash flow, as I said, is immaculate as usual. Revenue next quarter will go down, but it's how they tackle this problem, how they catch up with the likes of AMD with this chip. They're going to have to outsource it and try and get ahead of the curve. But interesting from him. Have you seen much from him?
So I don't follow Intel too closely because I just don't want to have the stock at the moment. And I had a question for you actually. It's like, how much time are you giving Intel to turn around the ship?
See, I'm not too concerned. I've mentioned this last week. They're still increasing that dividend. The free cash flow is still increasing. There's still plenty of room to grow that dividend. So for the next, I don't see that dividend being in trouble in the next 5 or 10 years. I don't know how much lower the stock price can go. I think we might have seen it come around the bottom. It might go a bit lower if there's a broader market dip. So I'm not overly concerned. As I said, their market cap is still much larger than their competitors. They're losing, they're losing market share, but I'm not overly concerned at the minute. I still think we have to give the new guy a chance as well.
But I find it interesting that you say that you're not concerned for the next 5 to 10 years with the dividend. But if I see their, let's say, these declines, these are quite steep, right? Quarter over quarter.
So you look at revenue, for example, and earnings last year and this year, they've been growing for the last 4 or 5 years.
Mm-hmm.
Both of those have been growing, even though individual segments haven't been growing as much as they like, such as the data. So the PC segment has been growing strong. We know with lockdowns and so on, there was strong PC growth and strong demand for it. So they've still been growing pretty okay. They haven't been like we might see later on, like IBM or something. They haven't been in a decline in that sense. They're really just falling behind in their manufacture of the chips. It's bad news that they're falling behind in competitiveness with some of their peers, and that's the problem. But in terms of numbers, their numbers don't look too bad at the moment.
I understand that, but I said we look forward, right? So the question is for me then, okay, so what will be, how much time will they need to catch up with competition? Will be 2 years, will be 5 years, will be 10 years, will be 15 years?
Yeah, and that's the job Pat will have, and I'm assuming they're going to outsource a lot of this 7 nanometer chip to get up to speed while developing their own chips as well, and trying to get ahead of the curve. That's what I'm expecting. I'm thinking the next 2 years is probably critical in that sense. But at the moment, I'm not. It's not something I'm concerned about at the minute.
Yeah, but it sounds like then that if I think now about that, right, it sounds to me like it will be dead money for the next 2 years. So whether I make an investment decision today or within somewhere in the next 2 years regarding Intel doesn't really matter then. Like, I personally can probably just wait then until I see some hope and that is turning around and then invest then, because in general I would like to have Intel in my portfolio like the old Intel. Yeah.
Yeah.
But the Intel of today, I'm not too sure. So I'm okay with waiting 2 years and see if it's in this case anyway dead money. So let's say it's trading between $45 and $60 or $45 $65 for the next 2 years. Then I don't need to be in a hurry now.
No, I don't see immediate hurry. I don't see the share price, for example, going up massively in the next couple of years. But I got them at an attractive yield historically for what Intel usually pay. And on top of that, they have, as I said, they just gave another 5% growth, which is better than some of my top performing companies as well. So I'm happy enough. I'm happy enough to own them. I understand your position, and there is no rush from my point of view either. But I'm happy to have them in my portfolio.
Good.
The second company I had a look at was IBM. And all I can say is, and this will lead nicely into our main topic, which is how to spot companies like this. But it was a pretty shit, excuse my language, pretty shit report. I mean, the revenue was down 80%, earnings was down 66%. Some of that was a huge tax bill that they had to pay. And again, the company has declined to give guidance for 2021. The only positive, again, as usual, is Red Hat has grown. But as you pointed out, it's still too small to make a meaningful impact on it. So a lot is going to ride on this company and how this new company goes. But at the moment, it doesn't look too pretty. And I suppose that's perfect leading into the question of how do you recognize declining business before it's too late.
Yeah, so there's the whole reason why I don't invest in IBM, because from a yield point of view, looks really attractive, right? But I find this really a yield trap. And also Uncle Warren Buffett, he invested in it, but he also pulled out quite quickly again when he saw what a mess it is there. But I guess, really simple. When I think about declining business, and what I've also learned from my experience with General Electric and Tupperware and such, my mistakes that I make, is a theory that you call active inertia. So active inertia is based on where I got familiar with this term is based on a Harvard Business Review article from, I think, the early 2000s. And the article was titled How Good Businesses Go Bad. And the whole story is effectively about the fact that the companies themselves, the businesses, they know that they need to change. They know that they need to radically change, but they do it with things that were successful in the past. Yeah, because management is not used to working in this new world. And this is for me already IBM, because when I look at IBM, I see some gray suits and bookkeepers. Yeah, I see nothing there. I mean, look at Microsoft, Amazon, all of those are eating their lunch, Adobe, and then compare it to IBM. Yeah, it's day and night difference. And they did the Red Hat acquisition, which I think was really out of the comfort zone for IBM to give them also so much power. So I think they're still a little bit like shaky on this one. But for me, it just shows already how difficult it is for IBM, because it's not that they don't have the financial bandwidth to make good acquisitions, right? It's just their culture. Their culture is the thing that's holding them back.
Sort of like an old-fashioned kind of culture, like the guys at the top have been around too long.
Old Boys Network,
Yeah.
typically this, yeah, definitely. And then, so for me, active inertia, right, is really, really an important sign here. And I did for just for a fun exercise, I put like the 2016 to 2020, I said headlines from the press releases from Q4 of every year. And I mean, it's killing me, right? Do you still hear something today about Watson when they talk about IBM?
No.
No. So that was the I said the headline in Q4 about Q4 2016. IBM Watson is the world's leading AI platform for business and emerging solutions such as IBM blockchain and enabling new levels of trust in transactions of every kind. I mean, I mean, people in IBM will probably disagree, but for me, Watson has been one big failure. It never lived up to the promise that it was giving to companies and to the world about what it could do. I think they won a game one time, but that's as far as how it got. But it doesn't give any meaningful contribution to the bottom line. So, but then and suddenly in 2017, they strengthened their position as the leading enterprise cloud provider. Yeah, and established them as the blockchain leader for business. Well, I would disagree with the leading enterprise cloud provider. That's definitely Microsoft and AWS. Blockchain, I think they are quite okay there. But
That
again, is this meaningful in revenue? Yeah.
yeah, it's the one thing that seems to the common trend is they're trying to get in early on this blockchain, aren't they? Like as early as
Yeah.
2016, and it's
Yeah. But come on, this is like I mean, what can I say? This is like Royal Dutch Shell selling oil and suddenly saying that they're the leading provider of solar panels.
yeah,
Yeah. It is a sign that they have nothing better to mention. Yeah,
yeah,
their biggest business at that time was all the infrastructure, the old iron, the old metal that they have, consultancy business. You never hear anything about it. Yeah, so
hmm
they are using arguments of things that totally don't contribute at all, and this is just a continuation over the years, and that means that they are trying to seek for those spots in their portfolio which are successful, and there's not even a consistent message over those years. It just shows that they're struggling like hell. And if you then look at their revenue, well, since what is it, 2010, 11, they had a little dip in the Great Recession in 2007, 2008. It went back up to 105 billion, and now 75 billion.
yeah.
That's a massive decline in revenue, right? If you then look at their earnings, I mean, it is the same, right? They still had let's say, a $14 earnings, or almost 15 non-GAAP. It's important to mention here. Back in 2015, and now in 2020, it's 867. And this leads me also to the next one around seeing a declining business, and this is what I learned from General Electric. General Electric at the time, the gap versus non-gap gap was really widening. And why does it typically widen? Because of the one-off things that happen, like goodwill impairments, write-offs on other things, on assets and such. This is typically because those assets are not so much worth anymore, right?
Yeah.
That's why all these one-offs happen. And why are they not worth so much anymore? Because they probably use the net present value calculation based on cash flows, and their business is just generating less. That's why these things happen. But from 2017 onwards till now, their gap to non-gap gap has been on, let's say, around 40 to 50% in general. Yeah, between the gap EPS, so the accounting standards that the government set to companies, versus their own interpretation of their earnings.
So the
This
the
is
the
crazy.
the gap. So what you're saying is the gap accounting is 40% less than the non-gap.
Yeah, that's what it comes down to. Yeah. So what it tells me again is this gap is widening. Yeah. So the question is, how long will this sustain? If they all the time come with one-offs, yeah, it becomes regular business.
hmm
Yeah, so they're
Yeah.
kind of cooking the books here. But what it means is because then you can say, oh, but free cash flow and such is doing pretty well. Yeah, because that's the money you're receiving today. But what it also means, all your assets that you had in the past are just worth less now
Yeah.
on the balance sheet. So you've not been creating really shareholder wealth. Yeah, and you're actually been destroying it over the years. So again, this is for me a really strong sign of a declining business. Their revenue is declining, their earnings are massively declining. I don't know if you see it, but I don't see product innovation. The only thing is blockchain. I see growth in Red Hat, but again, that's a small part of their business. Where's the other innovation? And I'm not talking about we invest so much in innovation and we do all these great things. I mean impactful bottom line innovation in the portfolio. I don't see it. And a few years ago, they were mentioning about what was it? Their new business ventures or something like that. That it was now 40% of their portfolio, then 45%. I don't hear them talking to that about that anymore either. Yeah. So now, and we know they are going to spin off a part of their business now. I think they want to, if they are smart, they spin off all the trash and,
Yeah.
and put all the debt in it as well and let that go bankrupt or something like that and let those shareholders lose on it and keep the crown jewels. I just don't think they will get away with it. So for me, it means they are heavily financially engineering now, right? And I don't have the graphs here with me, but there was also a lot of debt increase. So a few years ago, I noticed that. So another one, typically CEOs are promising good stuff all the time, nice comments. You see that in the Intel earnings as well. Well, it's just shit, yeah.
Yeah.
And why don't they just say it? Yeah, that's much more easier to do. Another one, and I haven't seen it necessarily at IBM, is that declining businesses usually overpay for companies they buy because they're probably not the most attractive companies for the well-performing companies to be purchased by. Because if you think about Disney and Pixar, why went Pixar to Disney? Because it really fitted well.
Yeah.
Disney was really giving them growth, but who wants to be under the IBM wings? I mean, Red Hat did it, but they got a really large premium on top of that. But it means also overpaying often, right? So
Yeah.
yeah, and then last one that I noticed is that declining businesses often look for internals in succession, and this is also what happened in IBM. I saw it in GE as well. And I have a feeling that often when a business is in decline, they are afraid for outsiders to shake it up or something like that. Yeah, so
Yeah.
that's my feeling. But I've given now like 6-7 reasons how I see a declining business, how I learned to start spotting them. And for me, IBM is at the moment a textbook exercise. I'm not saying that they will cut their dividend anytime soon, but they are now already in a decade, 10-year long decline.
Yeah.
Yeah, I don't think they can do it another 10 years. It might be a great turnaround story, but it needs to happen within the next 3-4 years,
Yeah.
in my opinion.
They're lagging too far behind. For me, from what you said, I mean, there's a couple of things there that would be easier to spot. Something like active inertia is something. It's hard to spot until after the matter. I think I don't think you can spot that straight away, but you can certainly see revenue declining and financial engineering. That's a big one. The difference in gap and non-gap and why it's widening, and it's not just the one off. It's been happening for the last 4 or 5 years. So there are two really big takeaways for me. But I'm going to ask you the same question you asked me. How long do you give a company like this? So if you own IBM and it is back in, I don't know, 2016 to 2015, how long do you give them?
Um, let's say like that, I would have sold it already by now. Yeah.
Mm.
So because of this, I can't tell you if this would be 2015, whether I would have sold it in 2016 or 2017. I don't know, but I would have sold it. And I can give you an example. I'm now doing my analysis on ExxonMobil, and I'm about to sell it for the exact same reasons. I see denial in the board of executives from ExxonMobil. I see asset impairments happening all the time. Whereas Shell or others are moving towards a sustainable business and invest. I don't see this in ExxonMobil. I see really clearly active inertia there. And because you mentioned you cannot easily spot active inertia, you cannot see in a quarterly report. But that's why I put all those statements every year after each other, and you see it all the time. Promises all the time. You see a kind of a bit of apology in it that they know they need to change. It's just not working. It's culture that's behind it, the thinking behind it. So if you put it in a timeline over 4 or 5 years and you read your reports, you can see it. That at least I can see it now.
Yeah.
And I see this now with ExxonMobil. I see it's all over the place. And I have a feeling that they're hoping that maybe via lobbying in the US that they can get away with it. But for me, they're not doing anything fundamental to their business, and they're in denial. And this is what I mean with active inertia here. It's all over the place. So. I haven't decided fully yet, but I'm considering, for instance, in ExxonMobil to dollar cost average out, to just sell some stocks every month or every quarter while the oil price is recovering.
Okay, that's not a bad strategy. Yeah, some very good points that you've made there, and it's a good one for me because I'm early in this process, and it's probably something I have yet to come across, and I'm sure it's something that I'm going to learn, and I normally learn better when it happens. I do have shares in IBM, and I'm hinging a lot on this spin-off. I'm hoping they'll do what you said, and they put all the crap to one side and let that dwindle away and really put their focus on Red Hat and the cloud. But time will tell. But there's certainly no denying that they are in decline and they are falling fast.
Yeah, I've, for instance, on Intel, as an example, I'm not too sure yet whether I would call, if I would be like you, invested in it, I would probably also not sell it yet. Why? I think it's too early to call them dead. Yeah. But you would really want to see action in 2021 on the turnaround and you don't actually want to hear them talking about 7nm. You want to hear them talking about what they are going to do with 5.
Yeah. I think the difference in Intel and IBM are like the worlds apart. I mean, you talk about revenue still growing. You
exactly. True.
Corporate culture. Look, they've went to the outside. I know it's somebody that was Intel, but he went away and he came back.
Yeah.
I don't think the CEO was promising anything. I don't think they fluffed anything up. And I don't see any financial engineering. So for me, they're two different companies.
Yeah. I'm with you.
Yeah. Cool. That was good, and as I said, it's good for me to hear this as much as our listeners, because I'm going to pay extra attention to IBM. I'm probably not going to sell them. I'm going to be stubborn and wait for it to bite me in the ass, but it'll be a good learning exercise. Maybe an expensive learning exercise, but a good learning exercise all the same. Okay, we move on to our listeners' questions.
Yeah, definitely.
Cool. So we have our first one is from Phil, which you probably would have guessed. And you've already ruined this question, by the way. And it asked if you had to sell one stock, who would it be and why?
Yeah, so ExxonMobil.
Yeah, you could have waited. You could have waited.
Yeah.
But for me, I'd probably sell Waco. I've said this before. I have them in my portfolio. I bought them because they were cheap. They were one of the first companies after Glanbia that I bought that paid a dividend, and they just sit there depreciating in price all the time. So that's probably who I'd sell. I kind of keep them as a reminder to myself to research companies before you buy them.
Okay, so then Piotr has also a question. He asks, and it's all a bit in line with this. I don't know why people are asking this. Maybe it's January. People are looking at their portfolio and that. Piotr asks, do you stick to the rule of selling stocks when dividend is cut or cancelled? If yes, how often does it happen? Or what percentage of your portfolio has been impacted since you started?
We did an episode on this on when we sell companies. Good few episodes, probably one of the earlier episodes that we did. I said at the time my thesis changed. It used to be straight out dividend cut sell, and it's not the case. It's not the case anymore. It's more of dividend cut. I have to look into that company now and decide if they fit my thesis. So, in terms of companies cutting the dividend, it's only happened two. It happened Disney, which I did sell, by the way, and it happened Tanger, which is a REIT, but they've actually reinstated their dividend again to keep their real estate investment trust license or whatever it is. So it hasn't happened a whole lot to me. How about you?
Well, it happened to several companies to me. So General Electric, as an example. Also at the time, I had a real estate investment trust, VRITE, and they also cut it. Then it was like 4 or 5 years ago. Tupperware, Royal Dutch Shell, Disney, Siemens actually did formally a cut of a few percent. I think that's about it in my portfolio. Yeah. So it does happen from time to time, but I don't indeed sell straight away. I sold half of them straight after the cut and the other not. So I'm not too religious in it. I know some other investors are indeed.
Yeah. And it's probably worth pointing out that you're obviously going through your portfolio now because it's January and you're looking to sell ExxonMobil. So it's not just dividend cut, it's maybe the performance and stuff as well.
Yeah, it's usually just like, is it still a high quality company that I want in my portfolio for the next 10 years? Yeah, and so I usually do it in the spring. I clean up my portfolio. I call it always spring cleaning. So, but with ExxonMobil, I might be a bit earlier.
Are they a tier 4 company in your portfolio? I can't remember.
Yeah, I think tier 3.
Tier 3.
But I already lowered them from tier 1 to tier 3 a while ago, like 2 years ago or something like that.
Yeah, okay.
Because we should not forget that ExxonMobil was the third company with a AAA rating a few years ago, together with Microsoft and Johnson & Johnson. It was a no-brainer to have ExxonMobil in the portfolio, but the world has changed a little bit in the last 3-4 years with the oil crisis.
Yeah. Okay. And Richard Whitehead asked us, do either of you own any industrial stocks in the defense sector, and any ethical concerns with owning these companies or concerns with them being reliant on government spending?
I'm not aware of owning one, so I actually don't know. I still have some General Electric, just as a reminder, right? So I don't know if they supply to the defense industry, but that's one of the reasons why I usually don't invest in Lockheed Martin or something like that, because you see it popping up sometimes. Knowing that always was in the back of my mind, and probably as supported in not going doing further analysis on it. Am I really ethical about it? If it's a really small part of the portfolio, it's different than when it's like 80% of their business. So I can't give a straight answer on that one. It really depends.
Lockheed have been all over Twitter lately, haven't they? I've seen lots of people buying the dip. I've seen that commented a few times. I don't own any. I know plenty that do. I have no ethical concerns whatsoever, but I don't have any of those companies at the moment, so I don't pay too much attention. Okay, and then we have Centrino, who asks, what happens when you suddenly want to buy a house or apartment and need a big amount of cash? Do you have to sell all of your stocks?
Well, so I saw this question coming in and I thought, like, look, not at the stage where I'm in now. Yeah, because I have a house that I bought. So, and if I would sell it, there's enough equity in it, which allows me to get a new mortgage somewhere else. So I'm in a total different situation. So when I saw this question, I thought, okay, but what if 10 years ago I was in a different situation? I would have probably, so let's assume like that. if I would have had like only 5% of the value of the house in savings, but you would need to pay down 20%, I would have probably need to sell my stocks. Yeah. If I
Yeah.
wanted really that dream house, the question is, would I adjust my requirements for the dream house, knowing what I have in my stock portfolio and on my savings or not? That would have been probably going through my head then at the time. Is it worth selling my stocks for that house?
Yeah, this question depends on the context a lot. My idea when I seen this is, well, first of all, is it an investment house or is it a house to live in?
Mm.
And if it's a house to live in, then should you really be investing that money that you rely on in the stock market? The stock market goes up, it goes down. You can lose
Yeah,
60%, you can lose 50% quite quickly. And if you're looking to buy a house, is that the best place for your money? I don't think so. I think that the type of investing we do is a long-term investing. Right? It's not short-term. You're not going to make a lot of money quite quickly. So I would not use that money for that. If I was starting and I was looking to buy a house, I would keep that separate, and I would
yeah,
only invest money after I have that money put aside, maybe. But
yeah,
if
yeah, exactly.
the only difference for me is if it's an investment house and with the portfolio that I'm at, if I was to use that money, do I get a higher return on investment? And that's a
Yeah,
different question.
yeah, true, true. The only other reason I could imagine, if there's an emotional reason why you want to buy something, let's say you can keep a house in the family because someone passed away, you would like to own that house, your dream house, emotional attachment. I could imagine there's something like that still,
Yeah,
but it would be not the wisest investment decision.
I've got a heart of stone. I don't get emotional over bricks
Yeah.
and mortar. Not for me.
Yeah.
But no, good question, and the context behind it would be good, and it could
Yeah.
open up a lot of discussion really in it. Nice.
Mhm.
Okay, and we have one from Tiago, and he asked us, what's our view on Aflac, ticker AFL. He's mentioned something about the PE and the dividend growth history and yield. So I know you've been looking at these recently, so it might be a good one for you.
Yeah, I've got a buy order outstanding. So I love the company when I looked into it, and I would like to have it around 3% yield, let's say. So I would want to buy it on the dip, but I think it's a great company, great business. I mean, everything looks good at this company, and yeah, I hope it will dip anytime soon, and I will pull the trigger. So I'm really with Tiago. I mean, what he says makes horror sense.
Yeah, I have a buy order in since November. It still hasn't got hit. Maybe I'm being too greedy, but I have a position in them already, and look, they're 38 years increasing dividends. The growth rate is phenomenal with the dividends. It's since 1999, it's up around 15%. I mean, what more? The cash flow is
Mhm.
solid. It's great company, and honestly, if I didn't have a position in them, I'd have no problem snapping up 2.85% yield. But
So you're telling I'm greedy.
yeah, in a roundabout way, I'm kind of saying you're greedy, but I am as well.
Cool. So last question then from ESET. What do you think about alimentation kush tart? Kush tart? I don't know my English here, but
I mean, in parts where I'm from, we use that kind of language differently. But I never heard of this company, ever heard of this company until I seen this question, and I've googled them, and then the first thing I see is that they have over 15,000 stores across Canada, United States, and Ireland, and I'm like, how the hell have I not heard of this company? But they own Circle K, which I believe you have in
yeah,
over where you. So they own Circle K, which are literally dotted all over the place. And I did not know that. So I'm glad this question came in because now I know that. And I have no opinion on them at the moment. But it might be someone that I might just be a little bit nosy in, just because they have lots of stores over here.
yeah. So I don't know them either because usually I'm not so focused on Canadian stocks for that reason.
Yeah. Okay, that was the last question. I really enjoyed them again, so thanks a million to everyone who asked. And today's stock recommendation comes from you this week.
Yes. So today I've got actually for me an interesting stock because I own a really small position in it. It's called Kimberly-Clark. It's actually not in my desired portfolio, but sometimes I think it should be in there. I bought it one time on a Monday when I thought like, hey, it looks interesting, and I snapped it up. It trades currently around 132 euro, and it has a dividend yield of 3.25%, let's say. But what you should know, what people could know Kimberly-Clark from, it's a consumer staple, like, for instance, Unilever, Procter and Gamble. And for instance, it's pretty well known for Huggies. So if you have little child's babies, not the Pampers, but the Huggies,
Yeah.
Kleenex, the tissues for your nose, Viva, Wipol. So it is really in the diapers and then the paper, let's say, a tissue and towel business. So, and it has been also growing their dividends for decades. I forgot to look up the number, but I know it's also a long-term dividend grower. It grew their dividends over the last 5 years with an average of 4%. And the nice thing about it is that on Monday they're announcing their earnings, and they had now 4 quarters, $1.07 as a dividend. So I expect a dividend hike coming up.
Okay.
So you could still snap it now at a current yield of 3.25. Payout ratio is around just above 60%. And yeah, if it would give you a hike of 5%, you would get it probably for, what is it, like between 3.4 to 3.5% yield, which I think is quite attractive for a company like Kimberly-Clark. It trades at, if I remember correctly, somewhere around 20 PE or something like that, 21 PE. So yeah, that would be my recommendation from today. It's a stock that not so many people often talk about, Kimberly-Clark, but it's one of those you could have in the bucket, like Unilever, Procter and Gamble, and
yeah. These are the kind of companies that dividend investors really love. They're boring. They just keep ticking over. They don't do anything special, but they're products that every single person needs. Everyone needs tissues. Everyone needs, well, not everyone needs nappies, but most people do. But I mean, boring, predictable, growing their dividend. What more could you want?
Yes, exactly. So if people are interested in it, look it up via the ticker symbol KMB. That's how you find it.
Okay. Cool. Interesting. It's always been one on my list. Like you, I haven't heard too many people. It pops up every now and again, and it's always in the back, but I've never got around to it. So it's really nice that you've mentioned it. It brings it to my mind again. And it's just looking at some of the companies like Andrex and stuff that I have in my house. I really love companies like that. So it's maybe one I might look at sooner rather than later. So thank you.
Cool. So it brings us to the end of this show, and I think our listeners can expect like 2 or 3 of these shows still in the upcoming weeks, where we will be going through the earnings results, because it's really lots of fireworks in the upcoming weeks.
Yeah.
So stay tuned for what's still coming. Some great companies reporting their earnings again next week, so it will be a rich show again, I think. And we also have a guest anytime coming up, right?
Yeah, we should have some guests coming up soon, so tune into that.
Good.
Okay, so we'll see you all next week. Take it easy.